class, time to talk about tax equalization as promised. So remember, tax equalization is when you go on assignment from your home to your host country, all the taxes that happen, whether it's income tax on what you're making, your wages, or tax on the allowances you get, like the cost of living differential, or the housing allowance, or the education, because most of those are taxable. Or just any random tax, whether it's, not sales tax. So it's always mostly income tax related, but on things that the company provides to you or your salary. So remember, tax equalization is you're not going to be taxed any more than you would have if you did not leave your home country. So the company will equalize it and pay that huge bill. And usually that's about 75% of the total cost of an assignment. So a lot of times it's up to or greater than your own salary, which is crazy, right? But I have a couple stories I want to share with you about tax equalization. The first one is we had a gentleman, and he was not on assignment. He was a Chinese local, and basically he wanted to be put on the Hong Kong payroll to avoid paying Chinese tax. If you know anything about that, Chinese tax can go up to 50% or more. Hong Kong is a flat 15%. So China, 50 or more. Hong Kong, 15%. So interesting. Obviously, he wanted to be put on Hong Kong payroll. The problem with that is China and the US are the only two countries in the whole world that if you are a citizen or a permanent resident, i.e. hold a green card, you will still have to pay the greater of your host or your home country tax. And what that means is you cannot break tax residency. You still have to file a tax in China or the US if you're a citizen or permanent resident, and you pay the greater of home or host country tax. So obviously you can be legal and do whatever you want to do, but at the end of the day, you should be paying your Chinese or US taxes. And if the company is enabling you to do it, now the company can say, I know nothing about it, you're on Hong Kong payroll, you deal with it. But at the end of the day, the governments can still go back to the company and demand that tax. A lot of times when we used to put people on green cards or citizenship in the US, what would happen is they would have holdings in other countries, and we had to, by law, tell them any bank account, any property, anything you have in another country will be taxed, will be subject to tax by the US government. There was a case where they found that the government where the company brought them in the US, but they did not tell the employee, and the company ended up having to foot the bill because the employee left the US. And even if you leave the US or denounce your citizenship or deny your green card, at that time, the US government will tax everything you have and take a tax payment. And so the company had to foot that bill. So just interesting. So that's my one story. Another story is I had an employee from Australia, and he was in the US, and he was from Australia. He went to Qatar in the Middle East, and then he came to the US. When he went to Qatar, he broke tax residency from Australia. In Qatar, it's a 0% tax country. Obviously, a lot of oil, a lot of money. So you get zero tax on your income, okay? So when he went to Qatar, he had zero tax on his income. Then he came to the US, and obviously he got taxed higher of US or home country, right? So he was taxed at the US rate. We did not tax equalize because it was a permanent move, not a temporary assignment. So we didn't tax equalize. We said, hey man, you're on your own. He got so angry that he left the company. And he left the company because the US tax rate and Australia are about the same, but he got used to paying the 0% in Qatar. And when he came to the US, he did not get a pay increase or much of one. So he was very angry because all of a sudden the money in his pocket was less because now he had to pay tax. So there's that story too. And there's all kinds of tax issues in the world. If you go to Amsterdam, they give you tax credit for the first, I think it's 8 or 10 years that you're there, and it's up to 30% of what you would owe for taxes. If you go to the UK, their taxes are super high. 50% or higher. France, another one, they have a lot of social programs. I mean, the more social programs the government has, like standardized healthcare and stuff like that, the higher your taxes go. Somebody has to pay for it. So here in the US, we enjoy a quite low tax rate versus other countries. But France, it can be taxed up to 75%. Another note about France is they actually have tax incentives. They give you a rebate if you own an island. So we had to deal with that from an assignee who went to, I think he went to Hong Kong, but was from France. And he said we owed him money because in France he would have gotten a tax rebate on his island. If we have those kind of problems, I don't think we really need a tax rebate. I'm just saying, you own an island, do you really need more money back? Anyway, that's taxes related to global movement and what companies have to deal with from an employee perspective if they move people globally. And also just things they need to think about from a tax strategy perspective. So I hope you enjoyed it.